If you've made it to this video, congratulations. You're already ahead of most beginners because you now understand the foundation of trading. But here's the truth. Even if you know everything about charts, patterns, and strategies, none of it matters if you don't know how to protect your account. Trading isn't just about making money. It's about keeping the money you've made. And in this video, I'll show you exactly how to do that through proper risk management. The same principles that helped me avoid losing my trading account when everything seemed to go wrong. Before we dive in, understand this. The fastest way to blow up an account isn't a bad market, it's bad risk control. Most traders think they lose because of bad entries or fake breakouts. But in reality, they lose because they risk too much, too soon. Trading without risk management is like driving a car without brakes. You might move fast for a while, but eventually you'll crash. So, let's start with the most important piece of account protection, position sizing. This simply means how much of your account you risk on a single trade. It's not about how big your lot size looks, it's about how much money you're willing to lose if you're wrong. As a rule of thumb, never risk more than 1 to 2% of your total account on a single trade. That means if your account is $10,000, you should only risk between $100 and $200 per trade. This one habit alone can extend your trading life and protect your capital during losing streaks. Next, let's talk about stop losses. Many traders fear using stop losses because they think it limits their profit potential. But in reality, a stop loss is your best friend. It's your insurance policy in the market. A stop loss is a price level that automatically closes your trade when the market moves against you. It prevents a small mistake from turning into a disaster. Every professional trader uses it. If you ever hear someone say they trade without stops, it's only a matter of time before they lose everything. The goal is simple. Define your loss before you enter the trade, not after. Now, once you understand position sizing and stop losses, it's time to combine them using the most powerful concept in trading, the risk-to-reward ratio. This is what separates gamblers from consistent traders. The risk-to-reward ratio measures how much you're willing to risk compared to how much you aim to make. For example, if you risk $100 to make $300, that's a 1-to-3 ratio. This means even if you lose 2 trades and win one, you still end up profitable. Professional traders focus on finding trades where the potential reward is always greater than the potential loss. It's not about being right all the time. It's about making more when you're right than you lose when you're wrong. Here's something that might shock you. You can be wrong 60% of the time and still make money if your risk-to-reward ratio is solid. Think about that for a second. It's not your win rate that makes you profitable, it's how you manage your losses. Beginners chase high win rates, but professionals chase good ratios. That's the difference between surviving and thriving in this game. Another key principle is account preservation. Your number one goal as a trader is not to grow fast. It's to stay alive long enough to grow consistently. Let me explain why this matters. If you lose 10% of your account, you only need an 11% gain to recover. But if you lose 50%, you'll need a 100% gain just to break even. That's why protecting your account is far more important than chasing huge profits. The smaller your losses, the easier it becomes to recover and move forward. Every successful trader you admire has one thing in common. They focus on defense first. Let's talk about emotional protection too, because risk isn't only about numbers, it's also about psychology. When you risk too much, every tick on the chart feels personal. You panic when you see red, and get greedy when you see green. You move stops, you close too early, you overtrade, and all of this happens because your risk was too high for your comfort level. Trading should never feel like gambling. You should always be calm enough to accept a loss as part of the business. If you can't sleep because of one open trade, it's a sign you're risking too much. To control that, build a personal rule before every trade. Ask yourself, if this trade loses, will I still feel okay? If the answer is no, lower your position size. That question alone can save your account over and over again. Now, let's look at practical implementation. Start by calculating your trade risk in dollars, not in pips or percentages. For example, if you have a $1,000 account and want to risk 1%, your maximum loss is $10. If your stop loss is 20 pips away, that means you should trade a size where every pip equals 50 cents. This simple calculation ensures you never lose more than you planned. And when you repeat this consistently, you build one of the most powerful habits in trading: emotional stability. There's also the concept of compounding safely. Many traders dream of flipping accounts, but real growth happens through controlled compounding. If you risk 1% per trade and make 2 or 3% per week, your account can double safely over time without stress or burnout. It's not flashy, but it's sustainable, and sustainability is what turns beginners into professionals. Something else to remember: never increase your position size just because you had a few wins. That's how traders fall into overconfidence and lose everything. The market doesn't care about your last trade. Stay consistent with your risk plan, no matter how good or bad the last outcome was. Treat every trade like it's your first. And here's an advanced secret most beginners never learn. You don't have to take every setup. Protecting your account also means protecting your focus. The more you trade, the more chances you have to make emotional decisions. Sometimes the best trade is no trade at all. If the market doesn't align perfectly with your rules, sit back and wait. Patience is also a form of risk management. Finally, always remember this: your account is your business. It's your capital, your lifeline, your future. Your job as a trader isn't to win big, it's to survive long enough to compound small wins into something meaningful. The market will always reward discipline and punish recklessness. Every trade you take should have a purpose, a reason, and a defined level of risk. When you master that mindset, trading stops being emotional and starts being mathematical. Now that you can protect your account, let me show you the exact strategy that got me funded. In the next video, I'll walk you through the full trading strategy I used from entry, including exit rules, 2 examples, and backtesting results, so you can see exactly how professional traders build consistency. Subscribe, turn on notifications, and comment, "I'm ready for the strategy below," because this next video will open your eyes to how real trading works.